Question number 2. We're going to talk about entry on credit spreads. What we're talking about here is looking at a standard credit spread and entering the positions, a bull put credit or a bear call credit spread. All right, this comes directly from Bill. And Bill says, perhaps you can talk a bit about the best strategies for entering credit spreads. What William just described, of course, was a bull put credit spread in that position. That's one of the twos. The opposite is a bear call credit spread. We're going to sell an out of the money call by a higher strike call for a net credit. Bill's follow-up is, for instance, what would be the best day of week to sell weekly options or longer term as well? My answer is Monday. I'm going to explain all of this, but I'm going to answer his questions directly here. My answer is Monday. And also, to clarify, the entry point on power options shows a bit more. It's the midpoint. That's right. When you run a search for a credit spread, a debit spread, the collar or the covered call, we're showing you the return, the initial net credit, based on the midpoint pricing, which we feel is fairly easy to get. And I've had success getting it with the spreads that I use. Bill is not having success, which is why he's asking these questions. It also says, I've noticed that when I sell more than one spread, even though the limit price I choose matches the mark, it just sits there, and after a while I have to lower it to get an entry. Okay? So what are the tips here that we have for entering a credit spread? I enter mine on Monday. Why Monday and when on Monday? Okay? Whether you're trading weekly credit spreads, weekly bull puts, 2-week out bull puts that I prefer, 11 days out roughly, or monthly credit spreads, you start to go through a pattern where in general you want to hold the positions, at least I do personally, especially my 2-week out spreads. I hold the positions as close to expiration as possible. And if they're still successful, they're still more than 3% out of the money or 2% even out of the money, I'm not going to worry about closing it. I'm going to let it expire and take the max return. I don't close for a 50% profit on these shorter term trades, these weekly bull put credit spreads, because I'm trying to maximize the return on the positions. I've also found, and you guys will see this when the next bull put credit, when the bull put credit spread product comes out, that closing early for a 50% return has not shown me that reliably over time it increases your win-loss ratio, because the positions that move against you to take a loss typically move against you fast in the first few days, meaning that they never hit the 50% profit. So what am I doing now? I'm closing more positions when they hit 50% of the expected profit, and I'm still losing on the positions, most of them, 9 out of 10 of them, I'm still losing because they're going against me. What does that mean? That means for my trading plan, I've cut my potential gains by a quarter or a half to the upside, and I'm still taking the same losses. That's not going to help me meet my targets in this situation. So I hold all the way to expiration, usually the Friday expiration. What does that mean? That means over the weekend, the money that I allocated for those positions, most of the spreads that I'm in, are now freed up. So on Monday, I'll enter the new trades again if I haven't closed or adjusted already. But in most cases, I'm holding to Friday, letting them expire, and then opening new positions typically on Monday when it's released. When I typically open positions, even with married puts, use income methods on the married put positions, close or roll married put positions or income methods or credit spreads around 12 to 2 p.m. Eastern time. Why? Today is a great example. I don't want to fight the morning fluxes. On a weekly bull put credit spread, 2 weeks out, 1 week out, we're talking about a net credit of 15 cents, 20 cents, 30 cents, 33 cents against maybe a 2.5 or 5 point strike difference or risk. So I don't want to sit there and say, oh, here's one that offers the good return, but the market's still moving down with this morning's action. Stocks are still reacting quickly, even up till 10:30. I'm swinging back and forth between midpoint prices. Well, that doesn't work for me. Why? Well, because I had 10 o'clock coaching session this morning. I had an 11 o'clock coaching session this morning. I had to put some of these slides together for our questions. So that's where we are. Okay. So I don't like to fight that. And at 12 p.m., 1 p.m., 2 p.m., the market's in a lull. Ernie used to call it that everyone on the floor is out to lunch. So there's a lull. The bid-ask spreads, in my opinion, are better. it's easier to get the midpoint price. You're not chasing the movement in the morning. You're not chasing the quick movements at the end of the day. It's just a nice, usually easy entry. And again, we'll put in that order to catch the midpoint when the market is slowed down, rather than trying to fight it with the flux of the open on a Monday morning, end of the day on Monday, or any other day for as well. But typically I find that Monday is when I enter the positions, because that's when the capital allocation that I had has been freed up. We're going to go into the new positions after that has happened, because I rarely close early in those situations. Okay. What am I missing? Aren't I missing time value on those positions? Yeah. Okay, so we think about a weekly option. We opened on Monday, we only have 4 days to expiration. If I opened on today, wouldn't that give me an extra 2 days? Or in the case of this week, wouldn't that have given me 3 days of extra time value? Because I'm gonna have to open on Tuesday if I'm opening bull put spreads. You're right. But what do I also miss? In these recent news-driven markets that we've seen for probably the past 3 to 4 years, 2.5 to 3 years, really, that's 2 days of unexpected events that could completely change my market sentiment in those situations. And I'm avoiding that so that on Monday, I kind of know where the market is at 12 to 2 o'clock. I know where the market is. I know where things are in that case, okay? And before we get into what a trade entry might look like, and we're going to evaluate just real quick on power options, what the spread looks like, how I set up my screen for what Bill had mentioned, but also take a quick look using the historical at a change in some of the prices. But before that, Aswin has two other questions that he asked before, but he asked this one related to this. He says, your timing for credit spread 12 to 2 p.m. Does that also apply for a naked put? To me, it does. Honestly, Aswin, to me, it does for the same reasons. If you're trying to sell weekly naked puts, you're out of the money by 7 or 8%, let's say. That's your targets, maybe 3 to 5%. And you're looking at premiums on quality stocks for a 5-day, 6-day trade that are 20, 25 cents. Well, if you see a bid of 25 cents and an ask of 40, you want to get that midpoint down. You want to get that midpoint of 33 or 34 cents. You enter it, and then you see the midpoint drop to 32, and you're thinking about lowering it, and the midpoint drops to 26. Like, oh, wait, now that's not as attractive as a position. When you're fighting the types of spreads we're talking about, and you're fighting really for 5 or 10 cents that could really change the return by 5% or more. It's better to do it when it's a more stable market and you're not trying to chase it in that case. William also added a comment there. He says, out to lunch for the market. You mean literally or figuratively? Yeah, it could be either in that case. All right, so let's talk about the power options screen there for these spread positions very quickly. And we're just going to look real quick at a historical question, and then I'll get to the other questions. I'm sorry, I do have one more email question that came in that's going to be rather quick, and then we will get to the other ones as well. Why can't I find what I'm looking for? I apologize, folks. There we go. I'm sorry. Here we go. Okay. I have to change screens. My apologies. And this time I'll make sure that we are unpaused. Fantastic. Here we are at the Power Options suite of tools. And I want to go into bull put credit spread, and we're going to go into search. We might look at this again next week. We might look at this again later this week, have a addendum to this recorded presentation related to spread entry. But when taking a look at the search results for the bull put credit spread, as Bill mentioned, here's one on Carvana. Stock's currently at 287.57. This is my weekly bull put default screen. It's looking 14 days out of time, 11 days out of time, really, because I look on Monday. Okay. So on Tuesday, it's going to be 10 days out of time for the following Friday. So 247.50. We have a 245 put, kind of closer than I expected, and a 246. I'm sorry, I read that wrong. I'm sorry. 287, 247 and a half, selling the put, 245. Now, if I did it at natural, this wouldn't be a credit. What do I mean by that? The option I'm selling, the higher strike at 194, natural bid, and the ask is 225 in this case. So this would actually be a debit of 30 cents if I got the worst case scenario. I'm going to target the midpoint at 52 cents. But Bill, you see how I've set up my screen here? I've set up my screen to look for, I'm sorry, the columns here. I have the short bid and the short ask, as well as the long bid and the long ask, so I can quickly gauge the midpoint. Now, this is the default weekly bull put that we have. If I can get this return, it's fantastic. This might seem a little extreme to me. 80 cents, that's not too bad. This is almost $1, though. So I do want to make a change here. I want to favor myself, make it a little bit easier, although I may lose some of these higher returns. And what I'm going to do in that case is down here in our criteria, where we can set what we're looking for time frame, minimum return, range out of the money, probability of success, of course. I'm going to look for, in this case, we have the short bid and the short ask. I'm going to keep this below 60 cents for the sell option and the buy option. I'm going to lose, oh, sorry, folks. I'm going to lose some here. I'm going to lose some of those higher return ones, of course, in that case. There we go. So we're just going to rerun the search. All right. And there we go. So now we have plug power up at the top. Second here. Click off that. There we go. And this is a little bit better. I'm still at a 23.5% return. That's really good. My target is here, about 15%. This is also important for Bill's question. But plug here at 60.14, maybe it'll sell the 45, bid of 102 and an ask of 105. Getting 103 is very feasible on this. A little bit wider bid-ask spread on the 43. This is a 2-point spread. Bid of 47, ask of 84. But if I get close to that 60 cents, we're going to be looking at a midpoint net credit about 38 cents on the position. Okay, even if I got 35, that'd still put me in this range. Okay, 17, 19%. I might not get 23. This is important because what I do is I'm going to put in that order close to that midpoint for this spread if I'm trading it. If it doesn't fill in the first 15 minutes or so, I'm going to see what the midpoint is and maybe back it off a little bit to 35. On a day like today, when the market was pulling back, what could have happened? I see this in the morning before the market opens, or I see it at 9:35 even. I put in a midpoint at 38 cents. Now, I might get filled because as the market pulled down, you can see plug power fell 640 today. So as the market probably dropped down $5 at the open, then continued to fall down like many other stocks, then came back a little and then fell down again. But at some point, I probably would have gotten filled at higher than 38 cents, but it wouldn't have had an 87% probability. That's going to fluctuate. And that might be okay because it's still showing me an 87% probability right now. That's market fluctuation. But again, that's one of the reasons why I'm waiting till 12 p.m. to 2 p.m. Eastern time to enter my positions. There's not as much market flux. But if it doesn't fill, I'll try it again in 15 minutes. I'll lower it down. Market still isn't fluxing as much between 12 and 2. So I look at 12:45, put in my position, hasn't filled by 1 or 105, lower it a little bit to the new midpoint, see where that is, and see where the position stands and go from there. That's my approach for doing this. Now, I haven't tested this thoroughly, as I mentioned, because I fell into the pattern of I'd open these positions and I want them to stay through Friday. Right? I want to get the maximum return. If the stock stays above 45 on January 29th, I want the full profit. I'm not going to close this if I can pay a debit for 19 cents to close it at 50% profit, even if I'm only 4 days in. I want to try to maximize the target because I want an average of 15% return on the winners with a success rate of 84, 85%. That's our targets. Do I miss much between days? Well, it depends on the day. Okay, so that depends on the day that moves. Okay, here's what I mean. Let's go back. We're going to go into backtest very quickly. And we're going to click on the Smart History Excel. We're going to go back to January 8th, last Friday, very quickly. And we're going to look at weekly bull puts, the default search we were just using. Go ahead and submit that. I might take a minute because we're uploading this. While that's uploading, I'm going to go back here real quick to just the bull put screen. One moment. So we're just going to wait for the historical data to come through. So it's testing the entire database of historical trades. There we go. Okay, so actually that came up faster than I thought. So let's just go ahead and use that. All right, so here's some positions we had on Baidu. This was from January 8th. This would have matched that default criteria if we ran the search near the end of the day, January 8th, last Friday. Baidu, Teladoc, Tesla. I'm going to look at MasterCard real quick. Stock was at 353.85 last Friday. Could have sold the 22nd of January, next week's expiration, 332.50. Not bad, 15-cent bid-ask spread. Probably could have gotten 139, 138 for that. And here it's only about 20 cents, okay, to about $1 or so. So yeah, we're looking at 31 cents net credit. Now this is only a 14.2% return, a little bit below what I'm expecting. But let's analyze this position, because the theory that we were talking about is that by opening this on Friday, am I not gaining 2 extra days of time value instead of opening on Monday? The answer is yes, but it also depends on what happens between Friday and Monday. On those 2 days, we don't know in a news-driven market, meaning what? Here's the MasterCard position. Originally, when we opened it, there's your 31 cents on January 8th, with the stock trading at 353.85. We go forward to the 11th. Stock's down to 348.20. Remember, we were looking at the 332, I believe, 50 strike. Now, the prices are much better, in a sense. Not much, but we're looking at about the same price in this situation, aren't we? The short option was at 213. The long's at 175. That's about a 38-cent net credit if I entered the bull put on that day. But the reason why is because the stock fell from 353 down to 348. This position wouldn't have matched my criteria because it no longer has the 85% probability, the minimum requirement that I'm using for those positions. And as you can see, well, the position didn't go so well here. This position is currently at a loss of 72.6% after the first week of trading, because MasterCard now is down to 323.36. 26, my apologies. Does that matter? This is a snapshot. This isn't every scenario. Let's run our search on Monday. So by the way, why is that 72% important? That 72% loss is important because I'm going to close my spread if it hits a 50% loss. I know this isn't really helping with the entry discussion, but what we're going to do now is look at the positions that matched our criteria on the 11th. The following Monday, instead of opening on the Friday, what if we waited and opened the positions on Monday where the stocks were declining? Do we even have MasterCard in our results? Yes, we do. 348.20. The strike now is 325. 322.50. Net credit of 30 cents, not 32, not 33, so it's a little bit lower, and it's completely different strikes, but we've got that probability for the next 11 days that we want. Where are we now on the MasterCard position had we opened it on Monday? Well, the stock has fallen. We saw it at the price of 323. In that case, it's going to be at a loss because this market as a whole has pulled back. It's got to analyze all the numbers there. So while it's doing that, let me go to Ashwin's question real quick here. Ashwin said, I see that you're using just delayed pricing. If I'm starting out with naked put, is this good enough for the 12 to 2 session? If you're trading monthly naked put positions, maybe even weekly, the 20-minute delayed might be fine. This is not my actual account. This is our webinar account. I do use real time for the weekly bull puts. And if I was trading weekly naked puts, I'd want to be on real time as well, Ashwin. Okay? But if you're doing monthly bull put credit spreads, maybe if you're even doing the weekly when the market has turned down, the 20-minute delayed might be fine for you in that scenario. Okay, so yep, this one, sorry, it wasn't earlier. It must have dropped by the end. I apologize. So I looked at this earlier, and this was only down about 22%, as opposed to the 72% that the MasterCard bull put that was opened on Friday was. We still have 7 days to go in this scenario. But here I'm pretty close to where I'd be closing this bull put spread position because of the decline of MasterCard. But remember what we were looking at. We were looking at a position, where we were selling the 325 put. That's why. Selling the 325 put, and today it closed at 323.26. When I look at this earlier at around 335, 340, in this case, the stock was at 326. So our spread that we opened on Monday was still out of the money. Now it's not. But the other position opened on Friday, in that case, is below both strike prices. Okay, so you're at near full loss in the position. There's some time value left, so it's only 70%, but you're at near full loss for the position. Okay, it's a snapshot. It's one position. Not all the positions that came up on the January 8th search are going to be like that. But we saw what news can come out. News came out today, of course, market reacting to news, of course, government and other. And we saw the decline, which we were expecting to see a decline recently and soon because of what the market sentiment tool was showing us in those cases. In that case, I should say, my apologies. But again, that's just kind of what we were talking about and why I prefer to open them in those scenarios. So again, real quick, just to review the question, there are guidelines for credit spread entry. Find a credit spread position, okay, that matches your desired return or higher, and I suggest Monday afternoon. Same with the naked puts, same with the covered calls. Bernie even tested and ran those picks of the day for the weekly naked puts and monthly naked puts, as well as the weekly covered call and monthly covered call picks of the day in the afternoon. Enter it at midpoint. Wait 15 minutes. If it doesn't get filled, lower it down, but keep in mind your target. So if your trading plan target, is around 15% for an 85% probability success trades, and you want a 15% leverage return on those positions, yeah, I'm going to start off with the higher ones. If I look at the stock chart and other information, I like it. But, so I'm 17.6%. So I have some wiggle room. And I want this. I want the 19% return. Do not get me wrong. But if it doesn't fill, I can lower that midpoint slightly. In that case, oh, you're looking at the wrong screen, aren't you? Wow. There you go. Okay, that's much better, isn't it? I was wondering what was going on there. My apologies. So in this case, I've got that 19.4% return. And if I have to lower it and I'm still making 17, I'm perfectly fine. Okay, so if it does not fill, lower the expected target, but keep to your trading plan. Don't just lower it and say, okay, I'm willing to take 10% because he's not filling me at the 15% I want. Move on to the next position. That's how I approach it. Some weeks, it'll still be tough in the afternoon. Not tough, but I'll still have some headaches in the afternoon depending on what's going on in the market, economically, globally, and other things. So what I'm going to look to do is, again, I'm not getting filled at the prices I want. I'm going to lower it a little bit. But hey, if I only get filled on 2 positions instead of 4, 3 positions instead of 4, I'm still okay with that because I have the targets I want and the fill prices I want. Maybe I'll look again on Tuesday, Bill. Maybe I'll take another look later.